Chapter 15: Stockholders' Equity. The three primary forms of business organization: proprietorship, partnership, corporation. Special characteristics of corporate form are 1. Influence of state corporate law, 2. Use of capital stock or share system, 3. Development of a variety of ownership interests. Capital stock or share system. In the absence of restricted provisions, each share carries the following rights: 1. To share proportionally in profits and losses. 2. To share proportionally in management and the right to vote for directors. 3. To share proportionally in assets upon liquidation. 4. To share proportionally in any new issues of stock of the same class, called the preemptive right. Variety of ownership interests. Common stock is a residual corporate interest, bears ultimate risks of loss, receives the benefits of success, not guaranteed dividends nor assets upon dissolution. Preferred stock is a special class of stock created by contract when stockholders sacrifice certain rights in return for other rights or privileges, usually dividend preference. Issuance of stocks. Shares authorized, shares offered for sale, and shares issued. The accounting problems are: 1. Par value stock. 2. No par stock. 3. Stock issued in combination with other securities. Stock issued in non-cash transactions and cost of issuing stock. Par value stock. Low par values help companies avoid a contingent liability corporations maintain accounts for. Preferred stock or common stock, paid in capital in excess of par. No par stock. Reasons for issuance: avoids contingent liability, avoids confusion over recording par values versus fair market value. A major disadvantage of no par stock is that some states levy a high tax on these issues. In addition, in some states, the total issue price for no par stock may be considered legal capital, which could reduce the flexibility in paying dividends. Two methods of allocating proceeds are: 1. The proportional method. 2. The incremental method. The general stock issued in non-cash transactions. The general rule is companies should record stock issued for service or property other than cash at the 1. Fair value of the stock issued, or 2. Fair value of the non-cash consideration received, whichever is more clearly determinable. Costs of issuing stock. Direct costs incurred to sell stock, such as underwriting costs, accounting and legal fees, printing costs, and taxes, should be reported as a reduction of the amounts paid in capital in excess of par. Features often associated with preferred stock: preference as to dividends, preference as to assets in the event of liquidation, convertible into common stock, callable at the option of the corporation, and 5. Non-voting. Features of preferred stock: they're cumulative, participating, convertible, callable, and redeemable. A corporation may attach whatever preferences or restriction as long as it does not violate its state incorporation law. Corporations purchase their outstanding stock to: 1. Provide tax-efficient distributions of excess cash to stockholders, increase earnings per share and return on equity, provide stock for employee stock compensation contracts or to meet potential merger needs, thwart takeover attempts or to reduce the number of stockholders, or make a market in the stock. Purchase of treasury stock. Two acceptable methods are: 1. Cost method, which is more widely used, or 2. Par stated value method. Treasury stock reduces stockholders' equity. Sale of treasury stock above cost or below cost. Both increase total assets and stockholders' equity. Retiring treasury stock. Decisions result in: 1. Cancellation of the treasury stock, and 2. A reduction in the number of shares of issued stock. Few companies pay dividends in amounts equal to their legally available retained earnings. Why? 1. Maintains agreements with creditors. 2. Meet state incorporation requirements. 3. To finance growth or expansion. 4. To smooth out dividend payments. 5. To build up a cushion against possible losses. Financial condition and dividend distributions. A company should not pay a dividend unless both the present and future financial position warrant the distribution. The SEC encourages companies to disclose their dividend policy in their annual report, especially those that 1. Have earnings but fail to pay dividends, or 2. Do not expect to pay dividends in the foreseeable future. The SEC encourages companies that consistently pay dividends to indicate whether they intend to continue this practice in the future. The type of dividends are cash dividends, property dividends, or liquidating dividends. All dividends except for stock dividends reduce the total stockholders' equity in the corporation. Cash dividends are board of directors vote on the declaration of cash dividends. A declared cash dividend is a liability. Companies do not declare or pay cash dividends on treasury stock. Property dividends are dividends payable on assets other than cash and restate at fair value the property it will distribute, recognizing any gain or loss. Liquidating dividends, any dividend not based on earnings reduce corporate paid-in capital. The portion of these dividends in excess of accumulated income represents a return of part of the stockholder's investment. Stocks, dividends, and stock splits. Stock dividends, issuance by a company of its own stock to stockholders on a pro rata basis without receiving any consideration. Used when management wishes to capitalize part of earnings. If stock dividend is less than 20 to 25% of the common shares outstanding, company transfers fair market value from retained earnings, or a small stock dividend. Stock splits are used to reduce the market value of shares. No entry recorded for a stock split decreases par value and increased number of shares. Large stock dividend is 20 to 25% of the number of shares previously outstanding. Same effect on market price as a stock split. Par value transfers from retained earnings to capital stock. Disclosure of restrictions on retained earnings. Restrictions are best disclosed by note. Restrictions may be based on the retention of a certain retained earning balance, the ability to maintain certain working capital requirements, additional borrowing, and other considerations. Analysts use stockholders' equity ratios to evaluate a company's profitability and long-term solvency. 3 ratios are 1. Rate of return on common stock equity, 2. Payout ratio, 3. Book value per share. Book value per share is computed as net assets divided by outstanding stock at the end of the year. The computation becomes more complicated if a company has preferred stock. Chapter 16. Diluted securities and earnings per share. Debt and equity. Should companies report these financial instruments as a liability or equity? Stock options, convertible securities, or preferred stock? Accounting for convertible debt. Convertible bonds can be changed into other corporate securities during some specified period of time after issuance. 2 main reasons corporations issue convertibles is 1. To raise equity capital without giving up more ownership control than necessary. 2. Obtain debt financing at cheaper rates. The accounting for convertible debt involves reporting issues at the time of issuance, conversion, and retirement. At time of issuance, recording convertible bonds follows the method used to record straight debt issues, with any discount or premium amortized over the term of the debt. At time of conversion, companies use the book value method when converting bonds. When the debt holder converts the debt to equity, the issuing company recognizes no gain or loss upon conversion. Induced conversion. Issuers wish to encourage prompt conversion. Issuer offers additional consideration called a sweetener. Sweetener is an expense of the current period. Retirement of convertible debt is recognized same as retiring debt that is not convertible. The difference between the cash acquisition price and carrying amount should be reported as a gain or loss in the income statement. Convertible preferred stock includes an option for the holder to convert preferred shares into a fixed number of common shares, such as classified as part of stockholders' equity unless mandatory redemption exists and no theoretical justification for recognizing a gain or loss when exercised. Warrants are certificates entitling the holder to acquire shares of stock at a certain price within a stated period. Normally arises under three situations. 1. To make the security more attractive. 2. Existing stockholders have a preemptive right to purchase common stock first. 3. To executives and employees as a form of compensation. Stock warrants issued with other securities, basically long-term options to buy common stock at a fixed price. Generally, life of warrants is 5 years, occasionally 10 years. Proceeds allocated between the two securities. Allocation based on fair market values. Two methods of allocation, the proportional method and incremental method. The proportional method determines 1. Value of the bonds without the warrants, and 2. Value of the warrants. The proportional method allocates the proceeds using the proportion of the two amounts based on fair values. Incremental method, where a company cannot determine the fair value of either the warrants or the bonds, uses security for which fair value can be determined, allocate the remainder of the purchase price to the security for which it does not know the fair value. Conceptual questions. Detachable warrants involves two securities, 1. A debt security, and 2. A warrant to purchase common stock. Non-detachable warrants do not require an allocation of proceeds between the bonds and the warrants. Companies record the entire proceeds as debt. Rights to subscribe to additional shares, stock right. Existing stockholders have the right, preemptive privilege, to purchase newly issued shares in proportion to their holdings. The price is normally less than the current price of the shares, and companies make only a memorandum entry. Stock option gives key employees options to purchase common stock at a given price over an extended period of time. Effective compensation programs are ones that 1. Base compensation on performance, 2. Motivate employees, 3. Help retain executives and recruit new talent, 4. Maximize employees' after-tax benefit, 5. Use performance criteria over which employee has control. Measurement of stock compensation. GAAP requires companies to recognize compensation costs using the fair value method. Under the fair value method, companies use acceptable option pricing models to value the options at the date of the grant. Recognition of stock compensation. The two main accounting issues are 1. How to determine compensation expense, and 2. Over what periods to allocate compensation expense. Determining the expense is compensation expense based on the fair value of the options expected to vest on the date they grant the options to the employees. Allocating compensation expense recognizes compensation expense in the periods in which its employee performs the service period. Restricted stock plans transfer shares of stock to employees subject to an agreement that the shares cannot be sold, transferred, or pledged until vesting occurs. The major advantages are 1. Never becomes completely worthless. 2. Generally results in less dilution to existing stockholders. 3. Better aligns employee incentives with company incentives. Employee stock purchase plans generally permit all employees to purchase stock at a discounted price for a short period of time. Plans are considered compensatory unless they satisfy all three conditions presented below. 1. Substantially all full-time employees may participate on equitable basis. 2. The discount from market is small. 3. The plan offers no substantive option feature. Disclosure of compensation plans. Company with one or more share-based payment arrangements must disclose 1. Nature and extent of such arrangements, effect on the income statement of compensation costs, Method of estimating the fair value of the goods or services received or the fair value of the equity instruments granted or offered to grant. And 4. Cash flow effects. Earnings per share indicates the income earned by each share of common stock. Companies report earnings per share only for common stock. When the income statement contains intermediate components such as discontinued operations, companies should disclose earnings per share for each component. Earnings per share simple capital structure. Simple structure, common stock has no potentially dilutive securities. Complex structure includes securities that could dilute earnings per common share. Dilutive means the ability to influence the earnings per share in a downward direction. Preferred stock dividends subtracts the current year preferred stock dividend from net income to arrive at income available to common stockholders. Preferred dividends are subtracted on cumulative preferred stock, whether declared or not. Weighted average number of shares outstanding. Companies must weigh the shares by the fraction of the period they are outstanding. When stock dividends or share splits occur, companies need to restate the shares outstanding before the share dividend or split. Complex capital structure exists when a business has convertible securities, options, warrants, or other rights that upon conversion or exercise could dilute earnings per share. Companies generally report both basic and diluted earnings per share. Diluted earnings per share includes the effect of all potential dilutive common shares that were outstanding during the period. Companies will not report diluted EPS if the securities in their capital structure are anti-dilutive. Dilutive EPS convertible securities measure the dilutive effects of potential conversion on EPS using the if converted method. This method for convertible bond assumes 1. The conversion at the beginning of the period or at the time of issuance of the security if issued during the period, and 2. The elimination of related interest net of tax. Other factors. The conversion rate on a dilutive security may change during the period in which the security is outstanding. In this situation, the company uses the most dilutive conversion rate available. For convertible preferred stock, the companies do not subtract preferred dividends from net income in computing the numerator. Why not? Because for purposes of compute EPS, it assumes conversion of the convertible preferred to outstanding common shares. Diluted EPS options and warrants measure the dilutive effects of potential conversion using the treasury stock method. This method assumes 1. The exercise the options or warrants at the beginning of the year or date of issue if later, and 2. That the company uses those proceeds to purchase common stock for the treasury. Contingent issue agreement. Contingent shares are issued as a result of 1. Passage of time condition, or 2. Upon attainment of certain earnings or market price level. Anti-dilution revisited. I ignore anti-dilutive securities in all calculations and in computing diluting earnings per share. EPS presentation disclosure. A company should show per share amounts for income from continuing operations, income before extraordinary items, and net income. Per share amounts for a discontinued operation or extraordinary items should be presented on the face of the income statement or in the notes. Stock appreciation rights. A company gives an executive the right to receive compensation equal to the share appreciation. Share appreciation is the excess of the market price of the stock at the date of exercise over a pre-established price. Company may pay the share appreciation in cash, shares, or a combination of both. Accounting for stock appreciation rights depends on whether the company classifies the rights as equity or as liability. Share-based equity awards. Companies classify SARs as equity awards if at the date of exercise the holder receives shares of stock from the company upon exercise. Holders receive shares in an amount equal to the share price appreciation, the difference between the market price and the pre-established price. At the date of grant, the company determines a fair value for the SAR and then allocates this amount to compensation expense over the service period of the employees. Companies classify SARs as liability awards if at the date of exercise the holder receives a cash payment. To record share-based liability, 1. Measure the fair value of the award at the grant date and accrue compensation over the service period. 2. Remeasure the fair value each reporting period until the award is settled. Adjust the compensation cost each period for changes in fair value prorated for the portion of the service period completed. 3. Once the service period is completed, determine compensation expense each subsequent period by reporting the full change in market price as an adjustment to compensation expense. Diluted earnings per share. Chapter 17. Investments. There are different motivations for investing. One is to earn a high rate of return, to secure certain operating or financing arrangements with another company. Companies account for investments based on the type of security, debt, or equity, and their intent with respect to the investment. Debt securities represent a creditor relationship. Amortized cost is acquisition cost adjusted for the amortization of discount or premium if appropriate. Held to maturity securities. Classify a debt security as held to maturity only if it has both 1. The positive intent and 2. The ability to hold securities to maturity. Accounted for at amortized cost, not fair value. Amortize premium or discount using the effective interest method unless the straight line method yields a similar result. Available for sale securities. Companies report available for sale securities at fair value with unrealized holding gains and losses report as other comprehensive income, a separate component of stockholders' equity until realized. Any discount or premium is amortized. Sale of available for sale securities. If company sells bonds before maturity date, it must make entries to remove from the debt investments account the amortized cost of bonds sold. Any realized gain or loss on sale is reported in other section of the income statement. Trading securities, fair value through net income. Companies report trading securities at fair value with unrealized holding gains and losses report as part of net income. Any discount or premium is amortized. A holding gain or loss is the net change in the fair value of a security from one period to another, exclusive of dividend or interest revenue recognized but not received. Investment in equity securities represent ownership of capital stock. Costs include price of the security plus broker commissions and fees related to purchase. The degree to which one corporation, the investor, acquires an interest in the common stock of another corporation, the investee, generally determines the accounting treatment for the investment subsequent to acquisition. If an investor has owned 0 to 20% of a company's security, it has passive interest and will value the investment using a fair value method. If it has 20 to 50%, investor has significant influence and will value it using the equity method. If it has 50 to 100%, investor has controlling interest. Investment valued on parents' books using cost method or equity method. Investment eliminated in consolidation. Holding of less than 20% accounting subsequent to acquisition with readily determined fair value and report investment using the fair value method. Without readily determined fair value and report investment using the practicability exception. Holding between 20 and 50% equity method. An investment, direct or indirect, of 20% or more of the voting stock of an investee should lead to a presumption that, in absence of evidence to the contrary, an investor has the ability to exercise significant influence over an investee. In instances of significant influence, the investor must account for the investment using the equity method. Comparison of equity method to fair value. Record the investment at cost and subsequently adjust the amount each period for the investor's proportionate share of the earnings, losses, and dividends received by the investor. Holding of more than 50% consolidation. Controlling interest when one corporation acquires a voting interest of more than 50% in another corporation. Investor corporation is referred to as the parent. Investee corporation is referred to as the subsidiary. Investment in the subsidiary is reported on the parent's balance sheet as a long-term investment. Parent generally prepares consolidated financial statements. Fair value option. Companies have the option to report most financial instruments at fair value, with all gains and losses related to changes in fair value reported in the income statement. Applied on an instrument-by-instrument basis, generally available only at the time a company first purchases the financial asset or incurs a financial liability. Company must measure the instrument at fair value until the company no longer has ownership. Impairment of value. The rules for debt investments, debt securities, and loans reported at amortized cost follow the same approach as discussed in Chapter 7. That is, companies should use the current expected credit loss model to record the impairment of debt investments similar to receivables. Impairment of value. Companies that have debt securities that are classified as available for sale use a different impairment model. Under this model, if the fair value is greater than amortized cost, no expected credit loss is recognized. Impairment losses on debt securities that are available for sale are limited to the difference between fair value and amortized cost. Reclassification adjustments. The reporting of changes in unrealized gains or losses in comprehensive income is straightforward unless a company sells securities during the year. In that case, double counting results when the company reports realized gains or losses as part of net income but also shows the amount as part of other comprehensive income in the current period or in previous periods. To ensure that gains or losses are not counted twice when a sale occurs, a reclassification adjustment is necessary. Defining derivatives. Financial instruments that derive their value from values of other assets. Example, stocks, bonds, commodities. 3 different types of derivatives are 1. Financial forwards or financial futures, 2. Options, or 3. Swaps. Who uses derivatives and why? Producers and consumers. Commodity prices are volatile. They depend on weather, crop production, and general economic conditions. To plan effectively, it makes good sense to lock in specific future revenues or costs in order to run their businesses successful. Speculators and arbiters. The speculator who may be in the market for only a few hours will then sell the forward contract to another speculator or to a company. Arbiters attempt to exploit inefficiencies in markets. They seek to lock in profits by simultaneously entering into transactions in 2 or more markets. Basic principles in accounting for derivatives. 1. Recognize derivatives in the financial statements, assets, and liabilities. 2. Report derivatives at fair value. 3. Recognize gains and losses resulting from speculation in derivatives immediately income. 4. Report gains and losses from the hedge transactions differently depending on the type of hedge. Intrinsic value is the difference between the market price and the preset strike price at any point in time. It represents the amount realized by the option holder if exercising the option immediately. Differences between traditional and derivative financial instruments. A derivative financial instrument has the following 3 basic characteristics. 1. The instrument has one or more underlyings, and 2. An identified payment provision. 2. The instrument requires little or no investment at the inception of the contract. 3. The instrument requires or permits net settlement. Derivatives used for hedging. Hedging. The use of derivatives to offset the negative impacts of changes in interest rates of foreign currency exchange rates. SASB allows special accounting for 2 types of hedges: fair value and cash flow hedges. Fair value hedge. A company uses a derivative to hedge the exposure of changes in the fair value of a recognized asset or liability or of an unrecognized commitment. Companies commonly use several types of fair value hedges: interest rate swaps or put options. Cash flow hedge is used to hedge exposure to cash flow risk, which results from the variability in cash flows. Report them on fair value on the at fair value on the balance sheet, and gains and losses in equity as part of other comprehensive income. The effective hedge on cash flows. There are no income effects at this point. Allied accumulates in equity the gain on the future contract as part of the other comprehensive income until the period when it sells the inventory. Other reporting issues: embedded derivatives. Convertible bond is a hybrid instrument with two parts: one, a debt security referred to as the host security, and two, an option to convert the bond to shares of common stock, the embedded derivative. To account for an embedded derivative, a company should separate it from the host security and then account for it using the accounting for derivatives. This separation process is referred to as bifurcation. Qualifying hedge criteria. Criteria that hedging transactions must meet before requiring the special accounting for hedges: 1. Documentation, risk management, and designation. 2. Effectiveness of the hedging relationship. 3. Effect on reporting earnings of changes in fair values or cash flows. FASB believes that fair value information is relevant for making effective business decisions. Others express concern about fair value measurements for two reasons: 1. The lack of reliability related to the fair value measurement in certain cases, and 2. The ability to manipulate fair value measurements. Disclosure of fair value information. Financial instruments, no fair value option. Both the cost and the fair value of all financial instruments are to be reported in the notes to the financial statements. FASB also decided that companies should disclose information that enables users to determine the extent of usage of fair value and the inputs used to implement fair value measurement. Two reasons for additional disclosure beyond the simple itemization of fair values are: 1. Different levels of reliability exist in the measurement of fair value information. 2. Changes in the fair value of financial instruments are reported differently in the financial statements depending upon the type of financial instrument involved and whether the fair value option is employed. Levels of reliability for fair value hierarchy. Level 1 is our most reliable measurement because fair value is based on quoted prices in active markets for identical assets or liabilities. Level 2 is less reliable. It is not based on the quoted market prices for identical assets and liabilities, but instead may be based on similar assets or liabilities. Level 3 is least reliable. It uses unobservable inputs that reflect the company's assumption as to the value of financial instrument. Chapter 18: Revenue Recognition. Identifying contracts with customers. Step 1. Contract. Agreement between two or more parties that creates enforceable rights or obligations can be written, oral, or implied from customary business practice. Company applies the revenue guidance to a contract according to the following criteria: 1. Contract has commercial substance. 2. The parties have approved the contract. 3. Identification of the rights of the parties established. 4. Payment terms are identified. 5. Is probable that the consideration will be collected. A performance obligation is a promise to provide a distinct product or service to a customer. A product or service is distinct when the customer is able to benefit from a good or service on its own or together with other readily available services. The objective is to determine whether the nature of a company's promise is to transfer individual goods and services to the customer or to transfer a combined item or items for which individual goods or services are inputs. Transaction price. Amount of consideration the company expects to receive from a customer. In a contract, it is often easily determined because the customer agrees to pay a fixed amount. Other contracts, companies must consider variable consideration, time value of money, non-cash consideration, consideration paid or payable to the customer. Variable consideration. Price dependent on future events might include discounts, rebates, credits, performance bonuses, or royalties. Companies estimate amount of revenue to recognize with expected value. Companies only recognize variable consideration if One, they have experience with similar contracts and are able to estimate the cumulative amount of revenue. And two, based on experience, they do not expect a significant reversal or revenue previously recognized. As these criteria are not met, revenue recognition is constrained. Time value of money. When contract sales transactions involves a significant financing component, interest accrued on consideration to be paid over time, fair value determined by either measuring the consideration received or by discounting the payment using an imputed interest rate, and company reports as interest expense or interest revenue. Non-cash consideration. Goods, services, or other non-cash consideration. Companies sometimes receive contributions or donations or gifts. Customers sometimes contribute goods or services such as equipment or labor as consideration for goods provided or services performed. Companies generally recognize revenue on the basis of the fair value of what is received. It may include discounts, volume rebates, coupons, free products, or service. In general, these elements reduce the consideration received and the revenue to be recognized. Company satisfies its performance obligation when customer obtains control of a good or service. Change in control indicators. 1. Company has a right to payment for asset. 2. Company has transferred legal title to asset. 3. Company has transferred physical possession of asset. 4. Customer has significant risk and rewards of ownership. 5. Customer has accepted the asset. Recognizing revenue from performance obligation over time. Measure progress towards completion. Method for measuring progress should depict transfer of control from company to customer. Objective of methods is to measure extent and progress in terms of cost, units, or value added. Accounting for revenue recognition issues, sales returns and allowances, repurchase agreements, bill and hold, principal-agent relationships, consignments, warranties, non-refundable upfront fees. Sales return and allowances. The right of return is granted for product for various reasons. Company returning the product receives any combination of the following: full or partial refund of any consideration paid. 2. Credit that can be applied against amounts owed or that will be owed to the seller. 3. Another product in exchange. Repurchase agreements allows company to transfer an asset to a customer but have an unconditional forward obligation or unconditional right call option to repurchase the asset at a later date. If obligation or right to repurchase is for an amount greater than or equal to selling price, then transaction is a financing transaction. Bill and hold arrangements, contract under which an entity bills a customer for product, but the entity retains physical possession of the product until a point in time in the future. Result when buyer is not yet ready to take delivery but does take title and accepts billing. Principal-agent relationships. Agents' performance obligation is to arrange for principal to provide goods or services to a customer. Examples: travel company facilitates booking of cruise for cruise company. Priceline agent facilitates sale of various services such as car rentals at Hertz. Amounts collected on behalf of the principal are not revenue of the agent. Revenue for agent is amount of commission received. Manufacturers or wholesalers deliver goods but retain title to the goods until they are sold. Cosigner, manufacturer or wholesaler ships merchandise to the consignee or dealer who is to act as an agent for the cosigner in selling the merchandise. Cosigner makes a profit on the sale, carries the merchandise as inventory. Consignee makes a commission on the sale. 2 types of warranties to customers. 1. Product meets agreed upon specifications in contract at time product is sold. Warranty is included in sales price, assurance type warranty. Or 2. Not included in sale price or product, service type warranty, recorded as a separate performance obligation. Non-refundable upfront fees. Payments from customers before delivery of a product, performance of a service, generally relate to initiation, activation, or setup of good or service to be provided or performed in the future. Most cases, upfront payments are non-refundable. Examples include membership fee in the health club, activation fees for phone, internet, and cable, Presentation, contract assets and liabilities. Contract assets are two types. One, unconditional rights to receive consideration because company has satisfied its performance obligation. Two, conditional rights to receive consideration because company has satisfied one performance obligation but must satisfy another performance obligation before it can bill the customer. Contract modifications. Change in contract terms while it is ongoing. Companies determine whether a new contract and performance obligation results or whether it is a modification of the existing contract. Separate performance obligation counts for as a new contract if both of the following conditions are satisfied. Promised goods or services are distinct, i.e. company sells them separately and they are not interdependent with other goods and services, and the company has the right to receive an amount of consideration that reflects the standalone selling price of the promised goods or services. Prospective modification. Company should account for effective change and period of change as well as future periods if change affects both, not change previously reported reports. Revenue recognition over time. A company satisfies a performance obligation and recognizes revenue over time if at least one of the following three criteria is met. 1. The customer simultaneously receives and consumes the benefits of the seller's performance as the seller performs. 2. The company's performance creates or enhances an asset, for example, work in process that the customer controls as the asset is created or enhanced. 3. The company's performance does not create an asset with an alternative use. Revenue recognition over time. The two methods of accounting are percentage of completion method, which recognizes revenues and gross profits each period based upon the progress of the construction. Buyer and the seller have enforceable rights. Completed contract method recognize revenues and gross profit only when the contract is completed. Completed contract method. Companies recognize revenue and gross profit only at point of sale, that is, when the contract is completed. Under this method, companies accumulate costs of long-term contracts and process, but they make no interim charges or credits to income statement and accounts for revenues, costs, or gross profit. Long-term contract losses. 1. A loss in current period on a profitable contract. Percentage of completion method only. The estimated cost increases requires a current period adjustment of gross profit recognized in prior periods. 2. Loss on an unprofitable contract. Under both percentage of completion and completed contract methods, the company must recognize in the current period the entire expected contract loss.